Good evening, everyone, and welcome. The first month of 2019 is in the books, and it was the best January for the S&P 500 since 1987. The snapback is a remarkable reversal from the big December sell-off. Strong earnings and a shift in the Fed's thinking helped propel the market. On this last day of trading in January, the Dow Jones Industrial Average fell 15 points to 24,999. The Nasdaq was up 98, and the S&P 500 rose 23. For the month, all of the major averages were up 7% or more. And it wasn't just stocks. Oil had its best January on record, rising 18.5%. Now, you may be familiar with the old adage, as goes January, so goes the year. But will that be the case this time around? Mike Santoli takes a look.
January was a dream for stock investors that almost fully reversed December's nightmare on Wall Street. After December's brutal 9% drop, the worst for that month since the 1930s, the S&P 500 logged the best January since 1987. And in fact, part of the explanation for the powerful rally to start 2019 is the extreme weakness late last year. The fourth quarter meltdown in the market depressed stock valuations and drove growth expectations so low that even the slower earnings progress reported in recent weeks has been good enough to reassure investors. The Federal Reserve also reversed itself sharply. Fed Chairman Jerome Powell in December spooked Wall Street by sticking to an expectation for further interest rate increases in 2019. But in January, he has radically shifted toward emphasizing patience in considering further moves. An old maxim holds that a strong January tends to predict a strong year for stocks, but there's not too much behind this supposed rule. An up January was followed by further gains the rest of the year, about 2/3 of the time since the 1950s. But over the past 15 years, the so-called January barometer worked 6 times and failed the other 9. Most recently, a year ago, when the S&P was up nearly 6% in January, but ended the year with a loss. The path ahead for stocks seems more tied to whether corporate earnings growth merely slows to around 5%, as is now expected, rather than falling outright. The market has now recovered more than half the 20% drop from September to late December. It increasingly seems that December was an overblown panic over imminent recession risks. But has the January rebound been too much, too fast? For Nightly Business Report, I'm Mike Santoli.